The UK renewable power generation industry has been one of the big success stories of the last 10 or so years. You'd say about 40% of our power is typically earned from renewable sources. Some days, a sunny day, a windy day, significantly more than that. That's been achieved with initially state subsidy, but today assets can be built and sustained without such subsidies in some cases. But really for the world and the UK to move beyond that into a truly sort of net zero environment, we need to look at things such as how do we grow our food, how do we consume that, how do we transport heavy goods, how do we conserve energy, and ultimately how do we harness the power of hydrogen, which is the most abundant element in the universe. So with questions like that in mind, I thought it'd be a good opportunity for Chris Tanner of Foresight Capital, who manages JLEN environmental assets, which we've been invested in since 2014. So over to you, Chris.
Hello everyone. So thanks very much for having me here to speak today. And I'll be talking about the opportunities that we see within renewables and actually more broadly environmental infrastructure and how they've changed over time. So I'm Chris Tanner and I'm a partner within Foresight's infrastructure division. I've been involved in infrastructure markets for more than 20 years now, and for 10 of them I've been one of the investment managers for JLEN Environmental Assets Group. So that's one of the first generation of listed funds on the London stock market that launched around 2013-14. So I've been active in the market since that IPO, and that's given me plenty of opportunity to reflect on changing market dynamics. I've also recently taken on the chair of the Renewable Energy Association's Finance Forum. So the REA is the largest and broadest of the various renewable energy and clean technology trade bodies. It has about 500 members, excellent lines into government, and this is a particularly interesting place to be at the moment, as this particular government is signalling its willingness to water down environmental commitments. So a few brief words on Foresight and on JLEN, although I promise this isn't intended to be a marketing spiel. Foresight is a leading alternatives manager with a strong focus on sustainability. We have 12 billion assets under management across 3 business lines. So there is infra, where I sit. We have a strong regional private equity business and also open-ended funds through Foresight Capital Management. And the firm has recently joined the FTSE 250 as well. In the infrastructure division, we have a strong presence in Europe and Australia, and we manage an extensive portfolio of renewables assets on behalf of our investors that spans the full range of renewables technologies. And JLEN itself is a diversified environmental infrastructure fund, and it has a broad mandate that has to date taken in 10 different technology types, some of which generate renewable energy, but some of which do not, but have other environmental benefits, and we'll touch upon some of those later on. We target a sustainable and progressive dividend, and we've been able to deliver that dividend every year since IPO. At the current share price, the target dividend for the year gives a yield of about 7.8%, which is very high by historical norms. Strong level of inflation linkage. About 62% of our underlying project revenues are linked to inflation. So that helps to underpin the progressive dividend objective that we have. And we are an Article 9 fund under SFDR, for those who follow these things. That's the deepest green colour of fund, and we put a considerable amount of effort into communicating what we try and do on the ESG front, and that's something we've been recognised for with a number of industry awards. So I'll now set out to show you how the broad environmental infrastructure opportunity is involved, and also show you some examples of projects and businesses that we've invested in. But first of all, we'll touch on a couple of definitions. So infrastructure is the basic systems and services that a country or organization uses in order to work effectively. So I like this definition. It's simple, and the concept should be simple. We can have an argument around what constitutes the truly basic needs of a society, if you like. Food, energy, yeah, I think we all agree on those. Transport, yeah. Does it extend to motorway service stations, data centers, fiber? You know, definition of infrastructure moves. We could also add to the definition by saying effectively and sustainably. We have a very effective energy infrastructure system that's worked for decades. We burn energy-dense fossil fuels, and it gives us abundant and convenient energy. The downside is that it appears to be cooking the planet. So if we now turn to a definition of infrastructure as an asset class, this is more difficult to get a handle on. So it's generally done by reference to the investment characteristics, so things like stable cash flows, inflation linkage, long-term assets, and so forth. But there's no objective standard as to what qualifies it for being infrastructure and what sees it fall just short. So we can take an accommodation public-private partnership project, for example, where you receive highly predictable inflation-linked revenues for 20 years just for making the building available. This is pretty much seen as a clear-cut infra asset, and investors have been very comfortable with this for a number of years. They've also generally been comfortable with economic infra assets like toll roads and airports, where it's possible to build a picture of stable demand that underpins cash flows over the long term. And then COVID happens, and suddenly those revenues aren't as predictable after all. And what about a renewable energy asset that receives a fixed price inflation-linked tariff for every megawatt hour that it generates? So removing market risk. That seems pretty good as an infrastructure asset. What about the same asset, but without that subsidy, such that it's entirely exposed to the wholesale market? Is that still an infra asset? What about an asset that starts life with a tariff, but then over the course of that life moves on to a merchant profile? And that's the case for most of the renewables assets that you see in the market today. So the point I'm trying to make is that infra as an asset class is a continuum. An investor can pick where they want to play based on their own views of acceptable risk and return. They can stick in core renewables towards the bottom left if they want, but my perception is that this is a pretty competitive part of the market to occupy. And that leads investors to look for new sectors that may not immediately be recognized as infra, but that feature some of the characteristics that good infrastructure assets have. And over time, actual performance will determine whether that particular kind of asset starts gravitating towards core infra, which I would argue that wind and solar have done over time, or whether the risks prove harder to mitigate. So if we now move to renewables infrastructure, so a recognized subsector of infra, and if you're looking at the London market, it's now actually a more populated area than general infra. So there are 22 investment trusts listed in that sector per the AIC, compared to only 9 in the general infrastructure sector. It started in 2013-14 with the launch of the first trusts, and they were really stimulated by the presence of these attractive subsidies. You generated electricity, you knew what you were going to get paid. And that satisfied the desires for predictable cash flows and inflation linkage. It also came after the UK's boom of providing government services through public-private partnerships came to an end in the wake of the financial crisis, and that changed the outlook for the general infra funds, and so there was room for this new class of infrastructure to attract investors' attention. It also came with new risks, so investors had to get themselves comfortable with resource risk. How fast will wind speeds be in a given year? How much solar irradiation will there be? And it also exposed general infra investors to wholesale market risks. Power prices go up and down, often with no rhyme or reason. So if the first funds, I should say with the notable exception of JLEM, which was always broader in its mandate, were wind, solar, or as the case may be, wind and solar funds, the subsequent proliferation of funds that I refer to has seen a substantial broadening of the opportunity set. So funds now exist with exposure to battery storage assets, to hydropower facilities, energy efficiency projects, bioenergy assets, including the production of biomethane, and also projects in the maturing hydrogen sector. So even as subsidies for new wind and solar assets are being removed or becoming less prominent, these other sectors often offer alternative models of revenue support. So they may not be as easy to understand or as straightforward as a feed-in tariff. They still have infra-like characteristics for those that are prepared to put the time in to understand the nature of these new support schemes. So I'll now turn to the market backdrop, and I hope that no one sensible would argue that we're not seeing evidence of the climate crisis on a daily basis. It's also incontrovertible that the last 8 years have been the warmest on record, and again, I don't think anyone really doubts that the major cause of this is emissions from human activity, fossil fuel burning and other greenhouse gases. We're warned about climate tipping points with alarming frequency, and the near-term climate goals that we are setting ourselves are already looking to be beyond us. So a 43% reduction in carbon emissions by 2030 already looks challenging, and I think this failure is particularly poignant on a day when the UK Prime Minister is being criticised from across the political spectrum for watering down the UK's own commitments. So renewables can help. On the next slide, we'll see that renewable energy is one of the success stories in trying to address the climate change. We still need more and faster deployment of renewable energy in order to see decarbonisation of the electricity sector, but that's only one of the sectors that are required to adapt. If we're to achieve net zero, it needs to be far more broad-based. So the graph on the left shows the sectors of the UK economy that are particularly responsible for carbon emissions, and the slide on the graph on the right shows how those emissions have changed from the particular sectors over time. So as I said, energy is a clear success story, so the thick black line at the top reducing significantly over time. But everything else has proved to be depressingly sticky. And here's the point. We can see sectors like transport, agriculture and food production, industry, heating are major emitters. And I think we can also agree that they are part of the essential systems that society needs. By the common definition, they are infrastructure. But if we don't come up with new sustainable alternatives to the old ways of doing things, then we have no real chance of achieving net zero. And this is the fundamental case for environmental infrastructure and the macro investment theme that a fund like JLEN is well placed to serve. We know we need these things, and if they can present investors with an infra-like risk-return profile, then investors will support them and help us get to net zero. And why is this so important? Because of the sheer scale of investment needed. So the FT reports that the scale of investment across all areas of the global economy is around $100 trillion to sort of 2050 and beyond. And although the costs of achieving net zero affect different parts of the world differently, all parts of the world will experience it as a cost by 2050. And unless other means are found to incentivize those changes needed, governments alone are unlikely to be able to get there. So mobilizing private capital is one of the things we need to do. So what's happening on the ground? What opportunities for investment are present, and what do they look like? So the key to unlocking private capital, the large amounts of private capital that need to be invested, is to provide some element of support so that infra investors feel that their investments have long-term predictability. As we've touched on, in the early days of renewables, the subsidy schemes in places, so often straightforward feed-in tariffs that simply saw you receive a fixed, and I should say as well, very generous market price for renewable electricity generated. They provided that predictability. And they've been hugely successful in supporting the market, enabling supply chains to evolve and reach scale, such that wind and solar are now among the lowest the lowest levelized cost of electricity out there, sort of comparing favorably to things like gas plants. But clearly it's not right that the taxpayer should continue to support mature sectors that do not need this support. And so subsidy regimes have changed over time. So now, where government support is still available at all, it's often on the basis of a reverse auction, where investors bid for the lowest level of support that they need in order to get the project built. And listed here are some sectors that still require government support in order to be cost competitive with traditional alternatives. So green hydrogen in the UK, for example, needed for decarbonisation of parts of the transport system that are hard to electrify, and also for industrial heat, is likely to be supported through a variant of the UK's contract for difference approach. So that's a scheme that is designed to minimise the amount of government support required if it turns out that the market price is higher than expected. And the general point here is that while government support will still be available for emerging technologies that are necessary for the transition to net zero, it's likely that the nature of this support will expose investors to greater levels of market risk than was the case in the early days of renewables. And navigating this landscape can be complex, and on the right you have some examples of policy pronouncements and also subsidy schemes, past and present, some of which are still with us, some of which actually disappeared over time, sometimes to the consternation of investors. And this is where specialist managers who follow these markets and understand these subsidy regimes come in. So I'll just say a few words about returns on infrastructure assets. So this is something that's particularly on my mind at the moment as a manager of a listed fund. So valuations of infrastructure assets are strongly correlated to the rate environment. So typically they are valued on a discounted cash flow basis using a discount rate that is influenced by the yield on government bonds. So taking that as a proxy for the risk-free rate. We all know how the rate environment has changed over the last 18 months. Rapid increases from a historical low to the point where we are now seeing rates not seen since before the financial crisis. And this has had a dramatic negative effect on the valuation of infrastructure assets. So in effect, what investors are saying to listed managers like me is that the levels of return that they were getting in the past on a portfolio of assets is not sufficient now. Same assets, doing the same thing, just not delivering enough of a return. So as an illustration, for most of the past 10 years for JLEN, investors have received a 5 to 6% yield. Now, at the current share prices, investors will be receiving a yield of nearly 8%. So that's a huge shift. And how are managers reacting? They're trying to find areas to generate higher returns. And this broadly falls into two camps. So you are seeing people seeking to invest into projects at an earlier stage. So that might be at the start of construction or even going further up the development curve and getting involved in the development of projects themselves. So there's generally considered to be greater risk in being involved at this stage of the project, and so returns are commensurately higher. And then the other thing that they're doing is they are seeking to diversify away from core assets into higher returning sectors. And so we've seen a number of funds add technologies to their mandates. Many of them are now pushing into battery storage assets, very much not subsidized assets with a high degree of market risk, but higher returning again. So what's clear is that a repricing of assets and of risk return expectations is going on in the market at the moment. And this means, in my opinion, that there are quite significant opportunities present. So the last few slides are examples of some of the broader environmental infrastructure investments that we've made And so I'll just skip through these briefly, but happy to return to them if people have a particular interest. So the first one is our investment into biomethane compressed natural gas refueling stations for HGVs. And this is a good example of how we're looking for infra-like characteristics in sectors where change needs to happen. So HGVs themselves are disproportionately responsible for emissions from the transport sector. They don't lend themselves to becoming electric vehicles. The batteries required to shift the weight are themselves heavy, and that compromises the effectiveness of the vehicle. So HGVs that are run on biomethane are simultaneously cheaper to run than diesel equivalents, and that's as a result of policy support that charges a different level of fuel duty for these trucks compared to diesel equivalents. And they also represent an emissions saving compared to the diesel equivalent of about 85% on a well-to-wheel basis. And so these factors underpin the investment case. You know, cheaper for users, more environmentally friendly for users, and that's underpinned by policy. And we've been seeing significant growth as we build out our network of stations. We have blue chip customers like John Lewis, Royal Mail and Amazon, and often these fleet operators themselves have made very public pronouncements about their commitment to reducing their carbon footprint. You know, so we consider them to be sticky. This slide shows our first foray into controlled environment aquaculture. So shown here is a land-based system for growing high-quality sustainable fish protein. This particular facility is under construction in Norway, and when constructed, it will operate to the highest standards of fish welfare and also biosecurity. Almost all of the water will be recirculated within the facility, and the waste from the facility, such as fish excreta and excess feed, will be processed within the project, producing a nutrient-rich biofertilizer that we also expect to be able to monetize. The fish growing operation itself has a more benign environmental footprint than traditional near coastal pen fish farming, where waste often pollutes the surrounding marine environment as fish feed falls through the open nets, and the fish themselves are often affected by disease and parasites such as sea lice. So here, our investment case is based upon the presence of a commodity market for salmonids in Norway that we've been able to track over many years. So we know that if we have to, we can sell into this bulk market for a commodity price that underpins our revenue assumptions. So if we were to do this, this provides us with an acceptable return, but the expectation is that the fish will command a premium price, and our partners there, our operating partners, are heavily incentivized to achieve this. And we're developing off-take contracts as we get closer to the first harvest. It's also the case that fish protein is one of the more sustainable and efficient animal proteins compared to alternatives such as poultry and cattle, and so we believe we're likely to see an increase in demand over time for high quality fish protein as diets change towards healthier and more sustainable choices. And then finally, green hydrogen. So hydrogen is an energy vector. You know, there are multiple uses of it, and a few of them are set out on this slide here. We see great opportunities in green hydrogen, with most Western governments preparing their own support schemes to ensure that they're self-sufficient in hydrogen as the energy transition progresses. On the part of JLEN, we already have investments in projects in Germany that are in late stage development and are due to start construction in the next 12 months. Germany appears to us to be the most progressed of the European nations in terms of enabling hydrogen infrastructure and also the support schemes necessary. And there are various regulatory factors in Germany that affect transport, that affect industrial heat use, and also blending within the gas network that act to underpin both the demand and the price for hydrogen that we'll receive. So right now we see hydrogen as one of the key opportunities offering higher returns, proven technology, and also sort of contracted and underpinned revenues that allow for predictable cash flows. So that's the end of this whistle-stop tour through the emergence of environmental infrastructure. There's a huge opportunity set here for those investors willing to look a little bit closer at projects and the grounds for considering them as infrastructure. And we certainly believe that JLEN is very well placed to take advantage of this particular mega theme that will come through over the course of the decades to 2050.